You seem to be in a real sweet spot here. You've got this project in Dubbo, just north of us here in Sydney. 15 rare earths, all of them so critical to tech, EVs, a mine life of 75 years, China restricting supply. When can you start?
We can start as soon as we get finance, Paul. And it's really interesting. People often say, well, why aren't you financed yet? I think the volatility from, what we just heard about with President Trump really drives investor decision. In our case, we're looking to build a $1 billion US facility. And so you can understand that people, before they make that commitment, think, oh, is this trend really going somewhere? Are electric vehicles really taking off? And things like that. We're ready to go apart from that financing step.
Well, we have a chart here on the Bloomberg that just illustrates how China's controlling the rare earths market at the moment. It's been slowing exports, so clearly a very strategic asset, a rare earths mine. Now you had a meeting with US defence officials in February about this, but didn't get any commitments. Are you surprised you're not getting more interest or indeed financing in this context of the trade war?
To be honest, I am, yes. I think when we consider that these supply chains, if you're looking to develop an electric vehicle, it's at least a 10 years R&D program. Similar for defence capabilities, these are 30-year life cycles. So when you're looking at strategic supply, you would think that you would look over much longer timeframes have been looked at. A lot of decisions have been taken in very short term at the moment. Otherwise, yes, I think people would have invested. We've seen the only running asset is Lynas, and that's because Japan has taken that strategic view. They're the only nation to do so, and the only nation who's secured for their manufacturing facilities a rare earth supply.
But of course, China has very aggressive pricing, which makes it really difficult for other players to come into the industry, right? What consequences is this having? You're right, Sherry. Their pricing is incredibly aggressive. For companies looking to sell through China, there's a 17% VAT that goes on. And so magnets, it's actually all about magnets. We've seen President Trump say, look, I want to restrict oxides, but what people really want is the little magnets that go into the electric drives. And China is by far and away the largest supplier, that 90% of the world's magnets. And they arrive pretty much at cost or below offshore. And so in my view, a lot of it's around government support for manufacturing investment in this space, as well as companies deciding, look, the risk of centralising certain parts of their manufacturing in China due to intellectual property and other things are too great, and therefore they're going to act. So how much backing do you realistically need in order to make the Australian supply chain competitive? So it's actually around the capital that's required to get it off. In our particular case, with a $1 billion project, the rough mix of debt and equity would see sort of $600 million of debt, including ECA, Export Credit Agency debt, and $400 million of equity. That's quite achievable. That's been done for Lynas, for Molycorp in the past to get those projects off the ground. But we're competing against Chinese companies who get effectively free or very close to zero cost debt. And so it's putting together offtake packages that allow that debt to be funded that's the most important. Pound for pound on operating costs, yeah, absolutely, Australian suppliers can mix it up and be profitable. We've seen that with Lynas, and it would be the case for us and some other potential suppliers here in Australia as well. There are some risks here, and Sherry was alluding to them there. Yeah. I mean, China is very aggressive on pricing. If we take a look at one key rare earth, for example, dysprosium, I hope I'm pronouncing that right. I mean, that's moved 59% year on year. It's really volatile. I mean, if this trade war is resolved in the time that it takes you to get the Dubbo project up and running and the price pulls back, where does that leave you in terms of viability? Well, in our particular project, Paul, we're in pretty good shape. Two things. The first thing is a lot of these things, there's a big difference between long-term contracts from a strategic investor and spot pricing. So we would have typically a floor price, quite a stable price would be presented to a major consumer. Second to that, in our particular project, we also have zirconium and niobium, which are other strategic metals that represent a large part of the revenue pool as well. And so for us, being a multi-element producer, we do get some price stability and can weather out the volatility in that case. But absolutely, that's a risk. And so I think a lot of people are saying, OK, let's just confirm the trend before we act, and which is wise,
in a risk management perspective and unwise in a supply risk management perspective, and that's the tension.
Yeah, in terms of being a multi-product, as we mentioned right at the start, you do have a gold mine as well.
We do.
That's in a good spot at the moment. Does that hedge you to a degree?
Well, we've taken a lot of the revenue from our gold side of the business and got it to get our project one of the most advanced in the world. You know, we own the land, we've got federal and state approvals, it's engineered, we're ready to execute outside of financing. And our exploration portfolio, South Africa Gold Mine's fantastic. You know, all investors can see that. You know, we've made gold sales in 2,080 Australian dollars, and last quarter our cost of production, all-in sustaining cost, was less than $950 an ounce, which is a massive margin. It's a purple patch we haven't seen before, and absolutely, that's why investors have got this, as you said right at the start, a double tailwind for Alkane at present, and we're really happy both with the positioning for the Dubbo project and also with our exploration for gold. So it's a great space to be in.